Most people don't overpay taxes because they make too much money. They overpay taxes because they deploy the wrong tax strategies based off of the income level that they're at. Millions of families and individuals pay thousands to tens of thousands of dollars more in taxes than they need to, all because they're deploying the wrong tax strategies based off of what income bracket they're at and where they're at in their trajectory with their financial situation. My name is Randy Clemens. I have helped save clients and former employers millions of dollars in negotiations, negotiating vendor contracts. I saved a liquid $100,000 by the time I was 26 years old, deploying some of these strategies for myself. And I am a former accounting student. I never went into the profession, but I did study accounting and tax law along with entrepreneurship while I was in my undergrad at UW-Madison. So this is an area of interest of mine, and I decided to start a financial literacy and tax literacy program and course in order to help people better their situation and keep more money in their pocket for reinvesting or putting into a personal family time, whatever it is, right? Whatever, however you want to utilize your money, but keeping more money in your pocket. So today we're going to go through 5 different income tiers and 5 strategies for each income tier that you can utilize, and you have to do it before the end of the year so that you can claim these things as a part of your tax credits for this is 2025. But most of these strategies will be able to be used for the next handful of years under the IRS code. So let's get started with the first income bracket. Let's get rolling with the first income bracket here. So this first bracket I am calling low to income and / early people early in their career. You're making anywhere from $0 to $75,000 on an annualized basis. Your primary goal is to increase your refunds along with lower your AGI or aggregate gross income to unlock different credits. Let's pull in these strategies. So the first one, and I've put some numbers on these, is to contribute max out to your traditional IRA. You can do up to $7,000 per person. So if you're a married couple, total $14,000 that you reduce your total taxable income for the year. Again, you can go up to that amount. You don't have to do the entire amount. You can do as much or as little as you want. But it is a way to reduce your total taxable income, which then reduces the amount that you actually get taxed on. The second tip is to max out your HSA contributions. So if you take a high deductible health insurance plan, you get set up with what's called a health savings account where you can contribute tax-free dollars to that account. So that gets, again, you can put in that money and it is not taxed. HSAs are great. They are called the triple threat from a tax advantage standpoint because the dollars are tax-free that you put into the account. They then don't get taxed when you make medical purchases or pay for medical expenses using that account. And you get to save that money if you don't use it in that given year. With FSAs, you do have to, you do lose that money at the end of the year, but with health savings accounts, you don't. And you can put that in a qualified investment account and allow that money to grow tax-frry. So you get tax-free gains on dollars that you end up putting in the market, which can be a huge advantage for people. I rave about health savings account. I've used health savings account most of my career, and I'm 33 right now, so quite a few years out of that, and it's just a huge advantage for people. Next, check in on different tax credits that you might qualify for. The Earned Income Tax Credit or EITC child tax savers credits, or the savers credits. You can end up, and this is just to throw an example on there, you can get 2,200 per qualifying child for the child tax savers credit, which can be a huge advantage for people. So check into those, or if you, again, working with an accountant, check to what you might qualify for to make sure that you're maximizing your credits, because those become a direct a deduction is different than a credit. A deduction reduces your taxable income. A credit directly reduces the amount of tax liability that you have. So you calculate how much your liability is. Say it's $5,000, and if you get a tax credit of $2,200, you're automatically reducing your tax bill from $5,000 to $2,800 just with that credit. It's amazing. Next, you can deduct student loan interest. If you have student loans that you still have to pay off, you can do up to $2,500 or whatever interest that you paid off. Now, again, you want to check into those because it can reduce over time, one, the amount of interest you're actually paying, but then also how much you actually qualify for what you're able to deduct on that student interest or student loan interest. Lastly, if you do have some sort of side hustle or you do run a business, you may want to try and defer some of that income. If you've got bonuses coming up, maybe defer that off to after January 1st. Or if you have expenses that you can pay and reduce, again, that amount of taxable income that you have, and you have the cash flow for it, you might as well take some of those expenses as well. So that is income tier 1. I mean, you could end up saving anywhere from, and not including tip 5 here, these are just broad brush amounts. It may differ based off of your situation, but anywhere from $500 to $3,000 put back into your pocket. And tip number 5, again, if you do have a business, even more than that put back into your pocket. So definitely worth looking into all of these. Next, the second tier, middle income families making anywhere from $75K to $200K. The goal is to reduce your taxable income and protect your family's cash flow. What are the things that you can do? One is maxing out your 401k or 403b contributions. These are your retirement funds, again, through your employer. If you say have like a 5% match, where if you put in 5% and they give you 3%, you might as well do that. That's a free 3% money that your employer is willing to give you just for contributing to your retirement account. Next, max out your HSA like we talked about before, along with, if you have kids, utilizing the Dependent Care FSA fund. This is, again, these would be 2 separate accounts. One is specific just for dependent care expenses. Think of like daycare expenses or not schooling expenses, daycare expenses or babysitters, anything like that. Or if you have a live-in nanny or just a nanny that works part-time, all of those things can be tax-free dollars that you use from a dependent care FSA account. Another thing that you can do is you bunch deductions for, say, charity. Let me spell charity correctly there. Medical, along with state and local taxes. So just check into any types of deductions you can take for stuff like that. Individuals or married couples, I think, can take up to, I'd have to check into this amount, but I think it's $600 or $650 per person. So it ends up being to $1,200 to $1,300 that you can reduce in your tax bill just from donating to organizations that you care about. Same with medical interest and bills, along with state and local taxes. Again, check into all those things and how you can maximize some of that. Consider donating to a donor-advised fund if you're itemizing. What this is you essentially set up like an account that you donate money or assets to, and it allows you to have a direct income deduction from those investments, and it allows those assets, whether it's, again, cash or say stocks or something that you donate to a charity, that also gets to grow tax-free for the charity. So it's a pretty cool way to be giving back to organizations. Lastly, look into harvesting losses if you had investment losses or offsetting gains you may have had. Again, to reduce your total amount of income. So if you had, say, lost $10,000 on a private investment that you had or had money in the market or whatever. Harvest those losses. Make sure you can maximize that on those so you reduce, again, your tax bill. That is income tier number 2. Number 3. Upper, middle / high earners is just, again, a category name. People making anywhere from $200,000 to $500,000 a year. Your goal is really to control surtaxes, so essentially taxes on stuff you've already paid tax on, along with smoothing your income volatility. First tip is, again, to max out that 401k, and along with the backdoor Roth option. If you don't know what that is, check in with if you have a financial advisor or your accountant. It's essentially another type of retirement account that allows you to contribute more dollars to it than the traditional IRA, which you get to max out at $7,000 a year. And again, it all goes to a retirement account, but it ends up being a huge contribution to your retirement, along with reducing your taxable income by a significant amount, depending on how much you put into it. Timing of your bonuses and RSUs, kind of like we talked about before. If you can delay some of those bonuses because you know it's going to put you into a higher income tax bracket based off of all the deductions and credits you're already taking, you may want to push some of that off beyond January 1, because then again you can reduce the actual tax bracket that you're in. Tip number 3, contribute appreciated stock to charity, just like we talked about in the last income tier. The great thing about this option is that you don't pay any gains on the appreciation of that stock because you're not selling it. You're donating it to a charity. The charity gets to receive that stock. It's a deduction for you. It's an asset. It becomes an asset for them, and it can grow and appreciate for the charity, providing additional gains for them, not just in this year, but years to come, depending on how they manage their assets. Tip number 4, evaluate exposure to NEAT and surtaxes. So actually I had to look this up. What is tax? Net investment income tax. Oh yeah. I just had brain fart on what this is. So any investment income, it's taxed at different tax brackets than, say, a wage income tax bracket like this, where you go work for an employer or for yourself, and you're earning wages. This is the tax rate for that income level, right? So the earned income taxes 10, 12, 22, 24, 32, etc., based off of which income bracket you land in. And again, it's a stair step. So the way it works is the first 10% is at this bracket. So the max married joint couple filing income taxes would pay is on the first 23,000 is 10%. Then the next chunk of money you get taxed at 12%, and then the next bracket is at 22, and et cetera, et cetera. So, but the investment income is taxed at different brackets. There's 10, 15, and we could actually look it up. Look up what are the brackets. So married filing jointly. It's 3.8% based off of the modified aggregate gross income. So anyway, going back to the example, you want to evaluate strategies to help minimize this, along with any other sort of surtaxes. And I'm going to move myself back over here, get this last. explore salt cap workarounds. Again, salt taxes are state and local income taxes, and any way that you can, again, legally move move funds around, move assets around, etc., to minimize the amount of tax liability that you have under these jurisdictions. So those are the five for the upper, middle, high income earners, and this again could save you anywhere from broad stroke numbers 7 to 20K based off of how you can deploy these strategies, where you're living, etc. There's a number of different factors, but a general range 7 to 20K, that's a pretty significant number. And of course, these just become orders of magnitude based off of what your income bracket is. Next, we're going to move to business owners and self-employed folks making anywhere from 100K to $1 million a year. So primary goals are to reduce self-employment taxes and shelter your cash flow. Your first is to review your entity structure. So how are you incorporated? Are you incorporated, for one? Have you actually filed entity structure incorporation documents with your state and the federal government? Are you an LLC? Are you a S Corp? Are you a C Corp? Are you a partnership, a limited partnership, a limited liability company, that's LLC? And then how are you structuring your business as members, as board members, as managers, etc.? So there's lots of fun stuff. I'll explore this topic in another video, but lots of cool stuff that you can help structure your business and your organization to reduce the amount of total tax liability that you have. Next, optimizing a reasonable salary for yourself, along with utilizing the business to pay for certain things that are for business purposes. Accelerate expenses accruals. So again, we talked about this briefly in the first tier, but if you have large equipment expenses, if you have if you're putting money into certain investments, if you investments being, say, and I think I'll get into this into the last bracket, but a cost segregation study for acquiring real estate properties. If you're able to take a accelerated depreciation schedule for a large piece of machinery, say if you're a construction company, you're buying a new dump truck or an excavator or whatever, right? And you can do in a depreciated schedule. That means you're front loading the amount of depreciation that you're accruing, and it reduces the total amount of income that is actually taxed. So lots of fun accounting strategies like that. Paying family members like your spouse or kids for legitimate work for the business that brings value to the business. And you can set this up in a way where, again, it's tax advantage. You're paying them, and it becomes tax-free dollars. You're helping them put money away into strategic accounts like we just previously talked about. So there's lots of cool things that you can do to structure paying your family and your business through your business, so that you're keeping more money, not just in your pocket, but in your family's pocket and in your employees' pockets. And if it'll allow me to move, there we go. Review eligibility for R&D or industry credits. So I can't think of any off the top of my head, so let's just look at something. What are available R&D credits through the IRS? Regular research credit is 20% of your current qualified research expenses. Alternative simplified credit. Key provisions, payroll taxes, yeah, qualified research, activities, permitted purpose. It has to be for developing or improving new components or products for functionality, performance, and reliability. Technological in nature, the development must rely on principles of hard science such as engineering, physics, chemistry, and computer science. Elimination of uncertainty. Let's see, are there any industries? Industry. Uh, so depending on the field that you're in, certain manufacturing activities, clean energy credits, research, hiring for specific demographics, rehabilitation and energy investments, credit for builders of energy efficient homes, carbon oxide sequestration credit, whatever that means. So lots of cool things that you can get tax credits on as an employer as well to reduce your total uh, tax burden. And um, this can end up being huge. Again, if you do run your own business, there's a lot of things that you can do here to reduce your tax liability. Um, this could be anywhere from like tens of thousands of dollars to hundreds of thousands of dollars, depending on how large you've grown your company and your organization. So lots of tax savings capabilities here. Let's move it on to the last stage, which I think should be the goal for many of you. I shouldn't say for many of you, for everyone. We want to start building wealth for your family, and it's not just the point of building wealth, but being able to pass things down to future generations and showing them how to properly steward them is a to me what the long-term goal really is for anyone. Now, everyone's got their own agenda, but I think that is the true agenda. The Lord has given us lots of gifts on this world, and I think it's our responsibility to steward those in a way that we are continuing to help the world uh, grow and and make it a better place for us to live for not only ourselves but future generations. Um, and I know we all have a finite time on this earth, but we want to make it a better place for the future generations to live in. That's my belief. So, anyway, the goal is long term tax control and legacy optimization. So, what are a couple of the tips? Execute advanced trust strategies, and this shouldn't say cheat trust, just trust. So you can set up family trusts, company trusts, where people manage control over things but don't actually own anything. There's lots of cool tax strategies that I won't go into in this video, but lots of fun things with setting up trusts properly. Consult the right um, professionals to do this, but it really can make a huge impact on your overall tax liability. Um, Definitely a big impact when you're making this much money, but the strategies can actually be utilized at lower income levels and help you propel to this state, right? Which I think many people think of it backwards as like, oh, I can't do these until this point in time. If it makes sense, you can, and it'll help propel you along this trajectory of making more income and getting to a different status from a financial perspective. Perform cost segregations on real estate. I mentioned this in the last video, but if you put money into an investment property that is a rental and you do all sorts of things with it, you can actually do what's called a cost segregation study. It's essentially breaking down all the components of the real estate itself and then saying, all of these components have a certain amount that's deductible, and it gives you a large portion of the actual real estate property that you can write off and reduce your taxable income with this. So that's why doing something like this might not make sense until you're making this much money, because it can have a huge impact on the total aggregate income. Use depreciation to offset active income. We talked about this a little bit before, but any way that you can, you're investing into things that are meant to help grow your business or your portfolio or your investments. And if it is an expense, figuring out accelerated depreciation methods that are allowed to offset the amount of income that you're actually making. Use charitable trusts or foundations. Again, donating money to organizations and trusts that, again, have a different purpose, but I would say a more humane, not that what you're doing isn't humane, but humane society type organizations that have humans at the forefront, doing specific causes like for hunger or cleansing water in different parts of the world, etc. Right? Stuff like that. If you're putting appreciable assets into those organizations or creating funds for them, that can be another way to reduce your tax liability as well, proactively. And the last one is really just, and there's more, many more. These are just, again, 5 tips across all of these categories, but lots of things that you can do. Coordinating your estate and income tax planning. So if you're starting to think 2, 3, 4, 5, 10 years down the road, 20 years down the road from a projected income tax planning perspective, what can you do to minimize the amount of overall tax burden that you have? And one bonus tip, review, and just like I talked about, multi-year tax projections. Figure out how much you might end up paying in taxes those years down the road, and then what things can you do today to reduce the amount of taxes you would end up saying. Again, 5 years from now, you're paying $100,000 in tax. How can you reduce that total tax liability come that point in time? So, what things can you be doing? And this in this category, this could end up being anywhere from $25,000 to $250,000+ in tax savings that you're making on an annualized basis. Again, consult your professionals that you're working with to help do some of these things. With that, I don't know about you. I think there's plenty of things that anyone can take out of this video, try to do in the next couple of weeks before the end of the year, and deploy these strategies to help put more money back in your pocket. And if you did enjoy this video, I'm going to be creating more content like this. Please hit that subscribe button below. And also check out Raising Capital on School. I'll put a link in the description below. But that's where I'm going to be hosting this program to help teach people about tax, financial literacy, and we'll have all sorts of programs to help you put more money back into your pocket, whether it's making more money or keeping more money from a tax strategy perspective. So look forward to seeing you at the next video, and looking forward to meeting you all in the community. And with that, we'll check you out next time.